Hello, traders. Welcome back to Gagrat Reading. My name is Antonio Garcia. Today we will talk about 5 tips or laws that you should always respect if you don't want to end up losing your money, emotions, and time. I know we all want to buy a Lamborghini with our trading, but trust me, it doesn't work like that. If you don't follow these rules, you won't even have enough to buy shoes. Before we start, if you are new here, don't forget to hit the subscribe button and the notification bell to stay updated on our latest content. Let's start with the tips that will keep you safe from the market predators. Tip number 1. The trend is your friend. This tip, though it may seem cliché, is actually one of the most essential guides in the trading world. The market trend can be likened to the current of a river, and your trades are like a boat sailing on it. Imagine trying to move your boat against the current. It would require a lot of effort, with minimal progress and a high risk of getting stuck or even going backward. It's exactly the same with trading. Trying to trade against the market trend can be a taxing and dangerous task. While it might seem tempting to try to beat the market, it's important to remember that the forces that drive market trends are incredibly complex, influenced by countless economic, political, and even psychological factors on a global scale. As an individual trader, going against these forces can be a risky bet. Of course, understanding the trend requires constant analysis and observation. Learn to read charts and understand the technical indicators that can help you identify trends. Make sure you understand the difference between an uptrend, where prices overall are going up, and a downtrend, where prices overall are going down, and adjust your trading strategies accordingly. Tip number 2. Don't trade without a reason or established strategy. If you do, you'll be gambling, not investing. Before entering a trade, make sure you have a well thought out strategy and a valid reason based on your analysis. An effective trading strategy takes into account a variety of factors, including your trading goals, your risk tolerance, and your trading style. For example, whether you prefer short-term or long-term trading. It may also involve the use of various technical and fundamental analysis tools to help you make informed decisions. Also, each trade you make should have a solid reason behind it, based on your analysis and strategy. Before entering a trade, you should be able to articulate clearly why you believe it's a good decision, what you expect to gain from it, and what signals would make you exit the trade. If you can't answer these questions, you probably shouldn't make the trade. Tip number 3. You should always use a stop loss and respect it. This is fundamental to manage your risk and protect your capital. A well-placed stop loss can be the difference between a small loss and a devastating loss. To set an effective stop loss, it's important that you analyze market movements and the volatility of the financial instrument you are trading. Your stop loss should be located at a level that allows some margin for the normal movement of the market, but also protects you from excessive losses. It's a delicate balance that will require practice and experience to perfect. I know it can be tempting to move your stop loss when the market moves against you, hoping that things will turn around. But this is a recipe for disaster. Never do it. Tip number 4. Control your emotions. Trading can be emotionally intense, but it's crucial to keep a cool head and make decisions based on logic, not fear or greed. If you definitely are not able to manage your emotions, no matter how much you try, you should consider quitting trading. It's sad but healthy for your mind and wallet. In the coming weeks, I'll make a video about this topic, which is undoubtedly crucial to survive the markets. Tip number 5, and the most important: manage your risk intelligently. Risk management is the cornerstone of successful trading operations. Without effective risk management, no matter how accurate your market analysis or innovative your strategies are, you'll be in a vulnerable position. This is where many traders, especially beginners, tend to go wrong and lose a lot of money. Remember, each trade you make should be backed by a clearly defined risk management plan. This involves setting how much you will risk in each trade. A generally accepted rule is not to risk more than 2 of your total capital in a single trade. Never risk more than 3 of your capital in a trade, as it will be a perfect ingredient for disaster. Also, it's vital that you understand the relationship between risk and return. The possibility of earning higher returns usually goes hand in hand with a higher level of risk. Having a risk reward ratio established will allow you to better evaluate whether a particular trade is worth it. For example, you can set a ratio of 1:3, which means that you are willing to risk 1 unit of loss for potentially gaining 3 units of profit. Another crucial part of risk management is diversification. You should not put all your eggs in one basket. Instead, distribute your capital among different assets and markets to reduce risk exposure. This is because different assets can react in different ways to the same market conditions, and diversification can help you smooth out these fluctuations and limit your losses. Also, you should be aware of your leverage. While leverage can potentially increase your gains, it can also amplify your losses. Therefore, you should use leverage cautiously and make sure you fully understand the associated risks before using it. That's all for today. I hope these tips help you on your path to trading success. Remember, continuous education and practice are key in this field. If you like this video, please give it a like and share it with your friends. See you next time.